Look, my key job today is to, hopefully host quite a coherent conversation with four, very diverse personalities next to me. And I do want to introduce who they are, starting with Ralph Stewart, founder and managing director of Lifetime Retirement Income. I first heard Ralph's name when I started my career at AXA, actually, and they said, the managing director, Ralph, what a great guy. He dresses up as in a Santa suit at Christmas time. So I never, lucky for Ralph, I never sat on your lap, which is probably good for your lap. But great to have you here today. We've got Jeremy Muir as well, partner at MinterEllisonRuddWatts. We all know that regulation is just becoming so much more important when we consider new products, so it's great to have you here as well. We've got Kim Mundy from the ASB, Senior Economist. I think in every session that you kind of have on retirement, there's always this chat around the affordability of New Zealand super and how New Zealand super really fits into the picture. So having Kim on the panel to answer those questions, give us all the solutions is going to be fantastic. And then I have Ben Brinkerhoff next to me. I have had the pleasure in sitting in many a chat or presentation that Ben has done in the past, one of the most enthusiastic people I've met, just in general, really, but is the head of advice at Consilium. So welcome everyone, looking forward to having a good conversation. So look, we've been given a topic which is considering what retirement income will look like in 30 years' time. And that's a long period of time. I think it was Bill Gates who said, we underestimate the change that we can do in 10 years, but overestimate what we can do in 2. So, extrapolating that to 30 years, the industry will look significantly different than it did today. So I thought a really good way to frame the discussion today is to actually think back to 1994 and think about what the industry actually looked like back then. And I'm not much good for that. In 1994, I was off to my second year of primary school with my school bag on. But the good news is, and you wouldn't believe this, but one of the gentlemen on the panel was front and centre of retirement savings in 1994. I think he was a couple of years ahead of me at school. So Ralph, take us back. What did the industry look like in 1994?
Oh gosh, Chris, thank you very much. I think you've identified me as the panel fossil. So to that end, I'm going to prove you correct and ask if we might be able to go back 30 to 40 years, because I was around back then as well. Going back 30 or 40 years, my goodness, what a different place it was. Oh goodness, there was no regulation as such. There was no Financial Advisors Act, there was no FMA, there was no FMCA, there was no industry associations, there was no association we have today. There was about maybe 25 to 35 managed fund products. Today is more than 700. It was not quite, but pretty close to an oligopoly. The insurers provided the investment products and the insurance products, and that was controlled by AMP, by Tower, by Prudential and by National Mutual, and then a few strangers off that. And they really were the product providers to the community. But distribution was materially different. I can't be sure, I've tried to research it out, but I think sort of 35 odd years ago, designations of agent was about 1,200. Designations of a financial advisor was about 300. So quite a different place. But perhaps the best way to describe how life was back then was to give you a practical example. I was a lot younger then, Chris, so as a cadet at Tower, there were two types of staff. There was indoor staff and outdoor staff. And I'm sure, as you can all imagine, the outdoor staff was the agents, and they were most revered. So the indoor staff would go out with the outdoor staff at night, and we'd go on sales calls. And I went on one wet Wellington night to Wainuiomata, which is one of the poorer ends of Wellington, Lower Hutt. We had 3 appointments. The third appointment was in a very small house, a lovely family, 2 small kids, a stay-home mum, and a husband who worked on the wharf as Orphy. There was just nothing at all. So we couldn't even consider whole of life, which in my view was a wonderful product. It combined life insurance and savings in one simple method. I'm sorry, it's gone. We ended up trying to find something that would work, and all we could really do was some term life. So we managed to insure $100,000 worth of life cover for the princely sum of $200 per year. The commission payable on that was 65% or $130. Off we went. I think it was less than 3 months later, the worst happened. The father of the wonderful family was crushed by a container on the wharf. So things were very different back then. We went to the funeral, and then we went out to meet with what was left of the family. And as we got to Wainuiomata and drove up the road, we knew something wasn't quite right. There were cars everywhere. And as we entered the house, there was uncles, aunties, second cousins, third cousins, and probably the neighbours all milling around because they knew what we had. We had the claims check. Because we used to deliver them ourselves in those days. The advisor, he had the wherewithal to calm things. We left. We drove back over the hill and went to Lower Hutt to Gibson Sheet and established a trust. The advisor, or the agent I should say, became one of the trustees on the trust, and we ensured that that claims check would go to where it was directed for, which was just the family. I know for a fact that the cost of Gibson Sheet's advice to prepare the trust was $700, 4.5 times the first year's commission. So the thought that I'm leaving with you from that story is that way back then, the economics of providing financial advice to middle New Zealand was hard. It's equally hard today.
Thanks, Ralph. And I mean, I think a good way just to bring context is to just bring it forward to, where are we today? So we've gone from an insurance-led market 30 years ago, and my goodness, you wouldn't have thought the industry would evolve to what it is, today. You mentioned the key players within the industry back then who had market share, and today the market share is with companies that weren't founded for at least kind of 1 or 2 decades later. I mean, look at us at Harbour. We were only founded in 2009, so the industry was really, really different. Ben, I've really sold you as a really positive guy, so I want to hear from you. How do you think the industry compares today to what Ralph just outlined? And what positives do you think investors are getting access to today that they weren't back then?
I think this is a softball question, right? Because everyone in the room knows how the industry is today, even before I say anything, because you're in it. It is phenomenally better than it was in 1994. And I think that is good context, because I think it will be phenomenally better 30 years from now than it is today. In fact, I would go as far as to say it will never be worse than it is right now. 30 years from now, you'll have another 30 years of people putting money into KiwiSaver of any variety, even if it's 6%. I sat down recently with the parents of my sister-in-law. The man's been an art teacher in New Zealand. He went overseas for a little while, came back, reached 65, no retirement assets. Owns a home, but needs to live, right? No pension, really, to speak of. I mean, I was blown away, at least in America, which is, you don't want America's retirement system at all. It's awful. But at least from California, I was from, CalPERS will give you something like 80% of your final salary for the rest of your life, right? So it's like you're a teacher your whole life, and it says, here, thanks, Now, the last thing you need to worry about is income in retirement. But this poor gentleman didn't have that. He said, what am I going to do? It's never going to be worse than it is right now. And now is phenomenally better than it was in 1994. How many advisors I spoke with have hundreds and hundreds of policies that are too expensive, clients don't know what they own, several $1,000s sitting in these old legacy locked up policies. You know, that was what people owned back then. No wonder they invested in real estate, honestly. But now so much better. There's good options, and there's a much more diverse, educated, articulate advisor force that you're able to access, and a lot more channels to put your money to work much less expensively.
And I'll get the rest of the panel to maybe put the tin hat on and say, you know, today, you know, we're not a perfect industry. We're so young in terms of saving. I think Nigel's point earlier was such a good one around, you know, 100 billion in KiwiSaver is a lot, but you know, you look at the likes of Aussie Super and the big schemes they've got over there, and you know, it's just a different beast. It's a different scale. That's kind of all ahead for us, really. You know, that's in our hands to shape, I suppose, what the next few decades kind of look like. So today, you know, where do you think we lack as an industry? And I'll maybe open this to the full panel.
I can speak to it from sort of more of a broader policy sense, but I think one of the things that really strikes me whenever we're thinking about retirement, especially when we're looking forward, is there is still a distinct sort of lack of uncertainty around what will and what will not exist by the time someone, say my age, hits retirement. And I do think that that uncertainty never helps decision making, so it does just leave a few people sort of in flux. At the same time, when you're dealing with housing affordability at levels that, you know, you've never seen, you've got debt at levels that we haven't seen before. So there are definitely some extra complications, I think, that a lot of people these days are having to deal with over and above just thinking about what retirement might look like, and then let alone, you know, will we have an NZ Super by the time we get to retirement. So I think some sort of clarity from policymakers around the future would be really beneficial.
Chris, I'm not sure it answers your question entirely, but I can't imagine what life would be like in New Zealand today without KiwiSaver. If that hadn't happened, if Sir Michael Cullen hadn't done what he'd done, that probably would have painted a very, very different picture for us, and we'd be a lot worse off.
But I mean, it's instructive to look back, as we started doing, look back 30 years to Australia, because of course 1992 was effectively where they kicked off, as I understand it, a large part of their current regime at a 3% sort of contribution level. So 30 years to now, look at where they are. So it's useful to look ahead for 30 years where we might be. But I think there's more to it than that. And I think, as you said, Ben, you know, it's only going to get better. It's at least only going to get different in terms of who we are, how we interact with other people, how we interact with assets. Technology is just at such an inflection point at the moment that, you know, I think looking ahead, it's going to be very, very different. So I'm keen to perhaps talk a little bit about that as we go on in the panel.
So the question is, what's lacking now? I think there's been a lot of discussion about that. And so I don't know what we're going to add more than has been added. I would say, thinking about independent advice space, there's a huge lack of financial technology. In order to be a successful independent advisor, you have to access scale. The way you get scale is you have technology. So you don't have in-house technology teams building you proprietary technology. So you have to be able to find that technology. In New Zealand, we just don't have enough money to get our own homegrown fintech very easily, and that is holding us back. So if we are able to get technology, we'd be able to scale better and reach more Kiwis. The other thing that strikes me is why New Zealand has a massive disincentive to invest in terms of its tax policy. I mean, I only can speak from Americans' perspective, but there's a massive tax incentive to save in America. You can save in a Roth IRA, and pay tax now. I can save in a traditional IRA. I can pay tax later when I'm on lower tax rates. I can decide which of those two. I put money into 401k. I can tax defer into that. So that, you know, America, we do everything wrong, but at least we figured out that we want to give tax incentives to save. But in New Zealand, we don't have a capital gains tax, but we have one called FDR, which is a capital gains tax. So we've disincentivized, you know, diversification. So why is it that we have we're tax penalizing investing in this country? Why do we have a quasi-capital gain only on, you know, investments? I don't understand what social policies is that achieving, and how is that to the benefit of investors? It can't be to the benefit of investors. So I don't understand how, from a policy perspective, New Zealand got to the point where it said, we're going to extra tax investing. It seems to me that it's in the interest of New Zealand to have as secure a population of retirees and as possible. And I'd love to see some good thinking about that so we stop gouging people. But anyways, no, I don't want to get controversial, but we have to get interesting. This is the second hour, everybody. You know, like, so.
I told you all he was very passionate once he gets going. I better not ask him the next question, let him cool down a little bit. Look, something that comes up all the time, Kim, is just around affordability. And I find it so hard to actually get a straight answer, because you will get political agendas around this. It is a real shame that this has become a vote-winning issue, you know, something as fundamental as the affordability of New Zealand super. You're an economist. I love economists.
Do you?
Yeah, Hamish, our economist, might have different views. But now, look, I mean, what's your view on that? I mean, it is, our demographics are going to look, you know, pretty different in 30 years' time. You know, our population's ageing. There's going to be a lot of people paying for others in retirement, which, you know, without getting into the social issues, just, you know, it does cause massive inequities. So, you know, where do you stand? When does it become kind of unaffordable?
I mean, I think, like, it will, but if we don't change the system, it will become unaffordable. I mean, we're looking at over 65s doubling in 30 years. I'm sitting here being like, right, 30 years, yeah, I'm 65. So I am one of those people. And even more importantly, from an affordability point of view, it's their share of population versus the working age, right? That dependency ratio, we're looking at it going from 4 taxpayers basically funding one retiree to 2 taxpayers funding one retiree. So that's putting a massive burden on future taxpayers to pay for, you know, what will be my super should it still exist then. So that means, and I guess the extra thing is we're also living longer, right? So you are being paid super for longer, which also increases the cost. So super as a share of GDP will just increase. Healthcare costs as a share of GDP will just increase. It suggests that debt as a share of GDP will increase. So where is this money coming from? Because, you know, we fund super out of general taxes. So are we going to be taxing those people more? Are we going to be borrowing more? Are we going to take money away from other areas which we will desperately need in the economy anyway? I mean, we've underinvested in education, we've underinvested in infrastructure. We'll need to be putting a lot more money into things like climate change, whether it's adaptation, mitigation. The sort of demands on government funds are just going to increase. So when you look across the sort of broader policies, then yes, I mean, unless we change something, it will be unaffordable. But then when you delve into, okay, so what are the changes we could make, whether it's raising the eligibility age, means testing, whatever it might be, it becomes very apparent very quickly that policy is complicated and there is no easy answer because people age differently ethnicity plays a role in it, gender plays a role in it, the work you do during your life plays a role in when you need to retire. So, you know, as only a good economist can, I'm not going to give you an answer other than, you know, we are definitely heading towards that unaffordability stage. And it goes back to what I was saying before. All that does, because we don't have any answers and we don't have any long-term policy looking at actually fixing the system, it's just creating uncertainty, more and more uncertainty for, you know, the people that are working and are some way away from retirement to say, well, you know, what will the future actually look like for me? And then you've also got issues around NZ Super has rested so long on the assumption that you own your home, and home ownership rates are falling, and they're projected to fall below 50% sort of in the 2050s. So maybe once we tip over that balance, we'll be able to talk about a capital gains tax, but it's going to be some way away by the, you know, recent policy that will be discussing that. So
I just don't want a capital gains tax on investment only. Yeah. That's the issue.
Or on investment outside of New Zealand,
yeah.
even only, which is the larger
the
part
anti-diversification
of the world.
tax, you mean?
Oddly, yes.
Chris, I think the issue of affordability needs context, and that context is time. It's a question that's not going to be solved in a hurry. It's probably potentially decades away before it's sincerely addressed, because it's for future retirees, not about retirees today. If you reprioritise the thinking and thought less about affordability and more about retirement in New Zealand today, 600,000 people aged 65 or older, incidentally 200,000 are in KiwiSavers, over 2/3 of those own their own home. Excuse me, not 2/3, about 45% own their own home. They have their NZ Super and very little else. They're not living the retirement life in New Zealand. They could, and no one's telling them how to.
And look, Ralph, I'll keep it with you, because we heard in the last session around decumulation, and I suppose one of the key objectives of this session is to really talk about the product development that's needed as things change. You know, as Kim outlined, you know, that dependency ratio of you know, 2 workers for every retiree, you know, that means a lot of people in retirement, and, you know, perhaps not the products to serve us. You know, you've been very active in this space. You know, what challenges do you find today in offering kind of these more innovative, you know, decumulation products? Because, yeah, if I had $1 for every time someone talked about decumulation, you know, I'd probably have about $100, which would be a decent amount of money. You know, what would you kind of, you know, what's your view on that at the moment?
Thank you, Chris. Respond partly just by sharing our experience, but also like to make some comments on the nature of how innovation's applied. In terms of some learnings in trying to create a variable annuity for New Zealand, we started 10 years ago. To try and give people in retirement the confidence to know that their income would last their lifetime. An obvious need that needed to be met and still needs to be met. It required, you know, immense capital cost, and basically creating an insurance company, an asset management company, and joining the two, bringing that to market, getting it regulated, so on and so forth, writing solvency standards for Africa. But the long and short of all of that experience was that when it finally did come to market, it was successful. It took a while. People were nervous of a guarantee, but over time, particularly as interest rates fell, they understood the need to be able to hedge that belief that their income would last their lifetime. What happened as a result, though, the gearing required to deliver that guarantee required the capital markets to effectively take longevity risk away from a retiree. So that has a cost. So the capital markets put a price on the cost of paying for that longevity that became too high to make it economic for retirees. Fair to say also, in raising capital to take over that longevity risk from retirees, capital markets weren't that inspired by it. Retirement space, retirement products, in particular regulated retirement products, were pretty hard to raise capital for. Our most recent attempt at innovation is to recognise that as we look for different solutions to help middle New Zealand today, who have that home, have that NZ Super and not much else, equity release is an obvious place to consider. but it's considered the ambulance at the bottom of the cliff. And got to find ways for that not to be the case. So we're trying to deliver the benefit of releasing equity from the home by, in effect, buying part of the home, not asking the homeowner to borrow money. So it's a different approach. And we've only just started, I don't know how we'll go. We've got to do 80 in a pilot by 31 March next year. We've only done 2. So we've got a way to go, and 300 to break even. So it's a wee way off. But just wanted to come back to the innovation point. Because if we're going to get somewhere in 30 years' time, we're going to innovate now. But innovation is something that will be a great outcome in 30 years, but 30 years is way too long to raise the capital to innovate. In my view, innovation is just another word for commercial activity. If you're going to be successful in innovation, you've got to find a need or a problem that's either new or old, is deep and is strong, and requires a very deep approach. For example, a variable annuity or changing the way in which you can release equity in your home, something deep. Capital markets won't support innovation that's minor and it's added on. We see a lot of, the innovation word is kind of cool. It kind of suggests the business you're in might be even sharp and smart because you're innovative. There's nothing like that in innovation. Innovation is just pure commerce. Finding a need, new or old, finding a solution for that need, raising the capital, being able to prove your idea within 3 to 5 years, and ensuring that innovation gets to a place pretty quickly within 5 years and can wash its own face. So it's in place to deliver big benefits 30 years out.
I think part of kind of what you brought up as well is just around regulatory kind of capture as well, and kind of how as new products come, regulation has to kind of catch up. And it's interesting, hearing Ben talk about FDR acting as a capital gains tax. It's certainly not. It's just outdated policy. When it was put in, it was because the dividend rate on overseas shares were a lot higher, right? Whereas today, it really does act as a kind of quasi-capital gains tax. I mean, Jeremy, kind of really interested in your views on the topic of regulatory capture. I know you've had a lot to do with, some of the more innovative areas of finance around digital currencies and alternatives. Are we good at adapting to new products as they kind of come to bear?
Yeah, I think in some ways we are, and in other ways we've got a lot of work to do. So as a country, the regulatory regimes that we have, and all of you will be very familiar with the legislation we have and the regulators, have come a long way. So when I came back from overseas in 2005, for example, I helped set up a small fund manager, and they immediately got a request for an investor from overseas who their lawyers, I think in Dublin, sent their usual due diligence request over here. And one of the key questions in there was, describe the regulation which applies to this fund manager in your home jurisdiction. And at that time, we scratched our heads, and the best we could say was, well, the fund manager is a company. So the Companies Act 1993 has directors' duties. That was kind of all we had. So I don't think we can lose sight of how far we've come in terms of actually bringing forward a lot of regulation. And I think we can also look at things like the Financial Markets Conduct Act and say that's working pretty well. And so in some of the areas that I work in, so for example, digital assets, cryptocurrencies, we're way ahead of a lot of other jurisdictions in terms of clarity in that legislation, because we can look at innovative products and we can easily stick it in a box and say, that's how it should be regulated in New Zealand. Unfortunately, where we're not so good at is there are a number of things, including a lot of things in that space, which just simply sit outside the regulation we have. And while that works quite well in terms of people being able to start projects and do things and innovate, it does mean that consumer protection lags behind, but also the benefit of being in a regulated industry, having the reputational stamp of approval from a licensing regime or otherwise is missing. So in New Zealand, we're quite binary in terms of we license a number of things that protect retail customers at a very high level, fund managers, derivatives issuers, banks, But a lot of other things that if you structure them in ways that sort of look like custody or use trust relationships and things, the level of regulation falls off a cliff pretty quickly. So I think we need to continue to grow flexible regulation, and we probably need perhaps some kind of sandboxing for innovative ideas so that people can come in and be in a relationship with the regulators from an early stage, even if the level of regulation is set at a level which allows them to get started. And we've had sort of inklings of that in Nicola Willis's speech this morning, talking about the Commerce Commission and the need to inject new innovators and disruptors into the banking sector, but also in terms of other investment products as we go. And also, using technology to introduce new ways of providing financial literacy. So some of the things that Sharesies is doing and otherwise are all about sort of helping grow those things. So the systems we have are pretty good compared to some other jurisdictions in terms of clarity, but we haven't quite got all of the settings right, I would say.
So there are a lot of questions coming through, and look, please keep them coming. Australia's come up a lot, and so I've got a question here from Timothy. Thank you, Timothy. Considering the challenges faced by the Australian super system, like high fees, complexity, multiple accounts, underperformance, disengagement, what specific lessons should KiwiSaver take from these issues to avoid us falling into the same pitfalls in 30 years' time? How do we avoid kind of being Australia?
There's a lot to say for being Australia. While there might be shortcomings, the Australian entry to the market being so much earlier than ours, as we know, the savings rates have produced demonstrable benefits over and above New Zealand, which I think significantly outweigh the disbenefits, whatever they may be. I would put more focus on being able to increase the savings rate than I would be to address the disbenefits created by Australia.
There are certain problems that come with prosperity. There are problems like people having a lot of money, wanting choice. People wanting to have a flexibility around how they decumulate. I wish we had more prosperity problems. I'd like some complexity that allowed advisors the ability to deal specifically with the needs of the person they're right in front of. That'd be a good problem to have.
Ben, while you've got the talking stick, I know this is going to set you off. You're going to be so passionate about this, and it's not specifically on our topic, but hey, we've got you on stage at the moment. Ben, when do you see financial advice shifting to being led by KiwiSaver discussions rather than your general, say, DIMS portfolio? And how do you see providers and tech combining to support this at scale? And I suppose just for broader context for people, I'm just continually shocked with the minimum amount that you need to see a financial advisor. In New Zealand, you hear of minimums in the hundreds of thousands. I've heard of some up to $1 million. How many people have $1 million to go and get financial advice? So, Ben, I suppose going back to the questions, when do you see KiwiSaver leading the discussion? And maybe for a little side one, if you can just talk about how to actually get the cost down, just so more people can get
There's
access to
so many
advice.
questions there. Can you pick one?
Yeah.
Which is your favorite?
I didn't know if that was rhetorical or not. Maybe start with, when's KiwiSaver going to lead the discussions, not be the, hey, where's your KiwiSaver? I'll add that on the side.
You kind of reach a point in life where you go, I can't make this up again. If I mess this up, I've messed it up. When do you reach that point? I mean, it's an open question. Scott Allman and I wrote an article on that recently, at which point you kind of reach, it's like the tipping point. And we we put out the idea, although I have no way of proving this. Maybe you can prove this, Jeremy, at some point. But it's at the point where your balance makes more money than your contributions. It's something ticks over in your brain that says, this isn't a savings account anymore, right? The amount I'm contributing matters less to my outcome year on year than what the performance of my account has been. And when do you get there? About 15 years in, if you start from zero. KiwiSaver's been around, what, 17 years? And then if you also look at, well, how do balances change from the first 15 years to, we all know you put more money in as you age because you generally your wage increases. So your second 15 years you're contributing more, plus not only on top of contributions, but the money that you put in the first 15 years is earning you interest and dividends. And from the first 15 years to the second 15 years, it's about a 3x difference. So let's say you had $100,000 after 15 years, you might have like $300,000 or $400,000 at the next 15 years. And you kind of get into that part of the curve and you think, I can't mess this up. I think people want to have this discussion from that perspective first and foremost. Recently on Thursday, I had someone from my church come by my house and he had paid off his mortgage, 45 years old, paid off his mortgage, and was saving $1,000 a week. That's $50,000. He's 20 weeks into this regime of saving $1,000 a week in a panic because he thought he wasn't going to have enough. All he has is KiwiSaver. And here's the thing. I thought, you are a unique animal. You've been in, most of your working life at 45, you've been in KiwiSaver, plus you just now paid off your mortgage, which you worked really hard on. And now you're thinking, although you may have needed advice years ago, now you're thinking, I need advice. So we're going to start to get this generation of people that started in KiwiSaver in 2007, are kind of getting old enough where they paid off their debt, and now they got KiwiSaver, and KiwiSaver's got to lead that discussion. And so I think that it's going to happen more and more and more. And one of the issues we have is that advisors are not really incentivized to give advice on KiwiSaver. That's a problem. We have this commission structure with KiwiSaver. You get 25 basis points no matter where you go. Sometimes you give you 50, but just the providers will give the same amount, to whoever, no matter what the quality of the advice is. So, advisors under that regime, if you think about the economics of that, Kim, right? Like, I'm incentivized, if I get paid the same no matter what the quality of my work is, then it's a volume-based business, and I'm incentivized to do as little as possible to get paid. That's a bad system. And that system does not work when people, that maybe works when I'm getting people into product. It does not work when I need to give people advice. So that's one of the innovations that need to happen. We need advice in KiwiSaver when this money is going to be what they significantly rely on to achieve their objectives. And by the way, just to finish with this, this gentleman had $100,000, his wife had $50,000. I did back of the envelope, between what they're contributing now to their, saving, which we can conclude only need to be $25,000 a year to achieve their objectives. So saving in that, plus when they cash up their rental, by the time this gentleman was 65, he was going to have about $2.5 million of investable assets. This is someone an advisor wants to talk to. But right now, the only thing you can engage with them on, really, is KiwiSaver. So advisors need to think about what does a future great client look like, even if that client doesn't fit your ideal client now.
It's a fantastic point just on the alignment. And actually, Jeremy, you were just picking up the microphone there. So,
yeah, no, I was going to make the point that the other phenomenon that we see overseas that people talk about in the superannuation space is the point at which your KiwiSaver or your superannuation savings becomes your second largest asset after your house, or so ahead of your second-hand car perhaps, but it actually reaches a point where you start to look at it and think, wow, I wonder what that actually is, and maybe I should know more about it. So I think as people's savings grow and it becomes a more significant asset, that I think will help a lot of people focus more on their own financial literacy and otherwise. Sure, it would be great if we get them into that earlier on, but I think you want to be ready for that point as well. And everything you say, I mean, Ben, about the advice community are part of the issues that we know we have in New Zealand. And I'm perpetually surprised, for example, that we don't have more different options for people to get simple forms of advice, so robo-advice options. If I look back at when we brought one of the earlier iterations of the financial advice rules in a decade ago or more, at our firm we did an experiment where we asked a number of our young lawyers, how would you like to get financial advice if you were going to get financial advice? We did a sort of an internal survey. Would you like to go and speak to a 60-year-old white-haired gentleman, possibly sitting behind a table in a wood-panelled office, and hear what they told you about your future and what it was going to look like? And unsurprisingly, a lot of them said, no, that's not really how we would like to receive financial advice. We want to interact with it, we want it in a digital form, we want to be able to approach it independently. So these are all gaps in the market that are yet to be filled. And we've had to play with the regulatory settings to allow that, but the legislation is now technology neutral and there are options for these things to grow. So I think there's a number of things we need to work on.
That conversation with the young lawyers is not driven by fear. At the point you're afraid of something, then you want to seek advice. When you have something to lose, right? When it's driven by opportunity, I want low engagement. When I have an asset I'm afraid to lose, and I don't want to mess this up and I can't make it up again, then you want to talk to the white-haired advisor, 60 years old, who's seen it all in the, wood-paneled desk or whatever it is. You want to talk to that person because you know what you want. You're talking to a young person, they don't know what they want. It's like it's Alice in Wonderland advice. If you don't know what you want, any road will take you there. So go online, and in the United States, go to Vanguard. Go direct. I did when I was in my 20s. I didn't know what I wanted. I just knew the more I saved, the better options I had. When I know what I want, then I don't want to lose that. Then I want to engage with someone who's going to give me a path or strategy to get there, and that probably doesn't happen until I get a little bit older, and that's okay. We definitely need that gap. But I would argue that gap is starting to get filled. We had Sharesies on here earlier in the last panel. I talked to Dean earlier from Colonel. The number of referrals I give Dean, he should be paying me salary. Just because I talk to people in their 20s and 30s, they don't know what they want, but they know they don't want to do nothing. I'm like, just go to Colonel, start saving. Is it short term, is it long term? That's almost what you need to know. Don't pay an advisor. When you know what you want, come back to me and I'll give you a referral to an advisor. But they're not that point yet. We're talking about thousands or tens of thousands.
Chris, Ben calls out the importance of advice, and we talked earlier about the economics of delivering advice, and agree with Ben. The other side of that coin is the role of providers. We're still preoccupied with saving for retirement. 99% of conversations in that space, the argument for not talking about decumulation is KiwiSaver balances are too small. When are we going to start to have the narrative about how different it is in spending space from saving space? It's not an excuse to say account balances are too low. Now is the time to start to think about decumulation in a KiwiSaver structure.
But Ralph, how do we do that, right? So we have basically poor tax settings for, you can't raise capital. We have poor tax settings for annuities. Even in America, annuities are about 2% of the market. That was your stat, by the way. I'm stealing it. So how do you do that? I mean, the advisors that we work at the Consilium, one of the things we try to teach them is just the basics of actuarial thinking. I have an asset. People want to spend it. They don't know what they want, but in a conversation, we can figure out what they want. The amount of spending people have changes over time, but there's data on that, so let's look at the data. Let's get some calculators, even crude ones, but there's some advanced ones. I know F&Z's working on a calculator that is looking like it's going to be great. And let's have a meaningful discussion, because where am I supposed to go online and have that and get that sort of decumulation advice, really?
Yep.
As an advisor, you would want annuities to be one of the tools in your toolkit to take some longevity risk off the table. It's very hard to get that.
Ben, I'd start very simply, and as you do with innovation, pragmatically. We know today there's over 200,000 KiwiSaver aged 60 plus. Decumulation is an issue for them now. If we look at the market share of KiwiSavers today, we know which KiwiSavers are customers for those 200,000 people. The largest might be 55,000 people. Why aren't they talking to them today?
I mean, just on that, one of the questions we've actually had multiple times here is, should KiwiSavers be leading the charge on creating an annuities market in New Zealand? And I suppose, from a fund manager perspective, I look at that and I go, why is the market obsessed with accumulation? And it's because it's a market we know exists and works, and we know that the regulatory settings are supportive in offering product there. When I look at decumulation, it's quite scary, right? You go, the regulatory settings aren't set up for it. It's probably going to be quite high fee, so I don't want to stick my head too far up above the parapet from a regulatory perspective. I've just got no idea what the addressable market is, and it's almost like the industry's waiting for someone to stick their head above the parapet, find the cost of capital that is required for making that kind of particular investment, discovering what the market actually is, and going from there. So I actually think it's something that needs a nudge, and the nudge needs to be maybe the regulation coming first and being proactive around facilitating that market, and maybe that will get people willing to take the risk with their own capital in offering products. That was actually a statement, but sorry, I'm supposed to be asking the questions. Yep. Ralph, do you have a response to that? As someone who's been there and done it.
I do. When we launched the variable annuity, the effective cost of capital for someone to take away that longevity risk from that retired person was about 1.35%. So the retail price for that retiree was 2.35%. Arguably, that was irrelevant, because depending upon that person's age, we guaranteed a rate for them. So if that was 2.25% or 2.5%, we would offer them a rate of 5% at age 65. Because the risk is variable, aka longevity, how long I'm going to live, and capital risk, that price of capital changes. And we suffered when interest rates fell, and we could no longer do this thing at 2.35. True cost of capital was closer to 4. And at that point, our 5% guarantee at 65 fell to 3.5. So it just didn't work. Subsequent to that, we reconstituted the same product, but took out the guarantee. And the price fell from 2.35 to 1.35. We retained over 92% of the customers we had who did have the guarantee. Point being that for the 1% capital cost is not having a guarantee that of a disincentive. We went for the guarantee initially because it was a really good proposition, guaranteed for life. Today, we give you an 80% probability that your income will last your lifetime. Is the former worth 1%? I wonder.
I would just add that advisors, if you're giving advice to people that have wealth and thinking about decumulation, then you have got to get familiar enough with the math that you could sit down in front of someone and say, yes, I think the strategy of decumulating in this portfolio at that rate is the risk of outliving your money, if we don't change your assumptions, is 20%. If you don't know how to do that, you shouldn't be giving this advice. But that is not a very difficult set of math to offer. There's tools to offer that. If you don't know about them, you can talk to me or talk to others. So those tools exist. And so we just need to educate advisors to be able to have that conversation. And even in a tool like Ralph's, capital markets will change, and that 20% chance of outliving will rise or fall. And what happens is you need to be able to track that in a way that says, okay, let's plan now on how we are likely to change things if we get a surprise up or a surprise down that we're not expecting. Let's have a withdrawal, Michael Kitces calls it a withdrawal policy statement.
Yep.
We're deciding today, even before that future event happens, if markets go better than expected, or you have an unexpected upside inheritance, how are we likely to change our plan? If, in fact, we have unexpected downside, let's bake in that conversation now, because that's going to be an emotionally difficult moment. And if we think about it now, when you're calm and I'm calm, then we can have a plan about how to handle those things. This is the kind of skill that I think the best advisors have to take advantage of. And if you are one of those advisors, then be happy that there's no mass market solution, because it makes you special for the time being.
Ralph, I think your question before was interesting, right? And it goes into that education that we heard so much in the last session around just engaging with people and just getting them educated on risk, because the reality is we all know when we talk to people, there'll be times when that guarantee probably feels like it's worth 10%.
Yep, very
There'll
fair
be times where it feels like it's worth nothing. I think on March 23rd, 2020, your guarantee, as markets were down kind of 20% month to date, people go, geez, 1% for a guarantee, sign me up.
Yes.
But there is, as Ben points out, there is, if there's good advice, if people are, really educated and engaged with on the topic, that's another potential solution as well. Now, look, you all have been sitting there so patiently. I have seen a few exit during the presentation. I've noted their names down to engage with them later. But I want just each one of you just to sum up with what's one thing. It's great to talk about 30 years' time. It's exciting to talk about the future. But what's something we can do today that we're perhaps not doing, to really, enable better kind of retirement incomes in 30 years' time? And I'll start with you, Ralph, and then I'll give you all a little bit of time to think.
I mean, 30 years is a long time. We talked before about the runway for innovation. If it's not successful in 5 years, it's lost. So we don't have 30 years to create benefits in 30 years. So join us in trying to innovate and implement good ideas quickly, fail fast and do it again, because then there will be a result in 30 years. I do just want to touch on the point around sequencing risk. There are a large number of New Zealanders today in KiwiSaver with the highest account balances they're ever going to have. If they have a market event within 2 or 3 years of retiring, that'll materially reduce the income that they'll have for the rest of their life in retirement. So providers that have those people address those risks.
Jeremy.
Well, if I was saying one thing now, I'm a big fan of increasing contribution rates for KiwiSaver, because that's a sort of an easy win to ensure people have more in their pockets later on. But I just think, as part of my preparation for this session, I went online to Wikipedia and looked at what are the movies that are set in the future in 30 years from now, in 2054. The first one I found in 2055 was a docu-fiction from the UK called The Age of Stupid, which I thought wasn't very promising. But the only actual film which is set in exactly 2054 is actually Minority Report, which many of you may recall Tom Cruise in a very digital future. And I think it is, if we look ahead that far and we see ideas as to what life may be like, what kind of assets we own, how the assets are digital versus physical, what we are going to have to do now is continue to grow quickly and flexibly towards the way that we save and own products that are in a number of different forms, physical or non-physical. So what I want to see with that is continued innovation through and regulation permitting innovation through ideas like sandboxes and otherwise. So that's where I'm sort of looking ahead at the moment.
I guess to bring it back to the economy, if there was anything that we could be doing now I agree we need to boost savings, but possibly the best way to be doing that as a whole is to boost productivity. Our productivity in New Zealand is woeful. It is very problematic, and until we can figure out a good way to actually boost and sustain an increase in productivity, we are going to have problems with saving. It's as simple as that. And you're also likely to have a more high inflationary environment that you're operating in. It reduces the productive capacity of your economy. It just adds a whole lot of headwinds to, the simple thing of wanting to save to live a good retirement. So I think that would be a place that I'd be starting at right here, right now.
Yeah, I have so many different ideas swirling in my head. I don't even know where to start. I know I have a minute, so I'll just say this, right? It's very difficult to give great advice on scale. It is. And a lot of people in this room have thousands of clients. Some of them call them customers, right? And giving advice to them on scale is very hard. I don't know how to do that, and I imagine you're struggling with that idea as well. But I tell you what, there are clients out there that are towards the end in their 55 to 65-year-old stage that have assets that they have enough that they could be getting advice and are not getting advice and desperately need it and can afford to pay for it and would pay for it if they could. Advice is a luxury good. Ramen noodles is not a luxury good. The poorer you are, the more ramen noodles you eat. But the richer society is, the more advice it consumes. As New Zealand gets wealthier, it will consume more advice, not less. Don't worry about robo-advice. People want advice the wealthier are. That's every society's conclusion, and it will be the same in New Zealand. Find the people right now you can afford to give advice to and offer it and give it and prepare them so that they can spend their money with confidence. Do that, and by doing that for people that can afford it, you will innovate and you will create scale, and then you'll say, oh, we can only do that at $200,000 balances. But guess what? Now we got really good at this. We can do that at $150 balances, $150,000 balances. Oh, gee, we're really good at that too. Now we can do that at $100,000 balances. And by solving the problem for the people that need the service, you will find that you develop systems and technology that allow you to go down into people that have less. So start there and solve that problem for the people that can afford it, and then learn and adapt towards people with less.
Fantastic. Look, let's wrap up there. Thanks, everyone, and please join me in giving a hand for our panellists today.